Hi everyone, I am David Lepton from The Reckoning, July 4th, 2030. Welcome to our seventh in a series of weekly podcasts. This episode explores a scenario where our collective national vice of overspending collides with the unpleasant remedy of fiscal restraint. There is a saying floating around, I think I first heard it years ago in investment circles, that the trend is your friend. Well, maybe it isn't. Here is a chart showing the explosion of U.S. national debt from 1990 to 2023. Let's remind ourselves of two stubborn trends that have enveloped our lives for the past half-century. There is no surprise here. We have spoken of these two trends before and will continue to highlight them. As a reminder, here are two charts showing what has happened. Our decline in productivity over 50 years from the 2.5 or 2.8% range down to near zero. Imagine a normal distribution curve in the upside down hue. That's what's happening to our productivity. Two, our uncontrolled spending and skyrocketing debt to the tune of $3.30 of debt for every dollar of economic output. Just imagine that graph with a line rising upwards from left to right at about a 45-degree angle. Many of our listeners may not be aware of how and when our government raises money from the future, multiple futures. Well, here's how it works. The U.S. Treasury holds auctions every week, every month, every year, year in and year out. The mind is easily repelled by how easy it is to take from multiple futures and pay ourselves in the present. The funds needed to pay for our addiction to overspending are simply printed and sold to buyers. That's it. Here is the auction schedule. This is what it takes to feed the voracious appetite of the American voter for debt-provided services from the government. There are Treasury bills, 1 year or less, weekly for terms of 4, 8, 13, 17, 26 weeks. You can have 52-week bills, and they are auctioned once every 4 weeks. If you want, you can buy Treasury notes for 2, 3, 5-year durations. These auctions are held monthly through the year, and 5-year notes are sold usually in June and December. You can also buy 10-year notes quarterly. Those with long time horizon can even buy 20 and 30-year bonds quarterly. Go ahead and make your day by attending one of these numerous auctions. Make the necessary inquiry at the U.S. Department of Treasury in Washington, D.C. Have fun. But do bear in mind that most auction participants attend online. You might be the only person there. Okay, this auction schedule is as informative as it is boring. I suspect most of our listeners will never attend that auction. Why should they care? I refer my listeners to two failed auctions in the last decade. Germany in 2011, when 1/3 of their bonds went unsold. The Eurozone crisis in 2013, when the European Central Bank had to, quote, support, end of quote, the auctions of Spain, Portugal, and Ireland. In both cases, unsettled conditions lasted for days or weeks. Again, surf the web or ask your friendly ChatGPT guru. Yes, it could happen here. In 2011, a red flag went up. It's a big one. Standard & Poor's downgraded the U.S. credit rating from AAA to A++. The reason for this downgrade, guess. Rapidly rising deficits and proposed deficit reductions just did not go far enough as far as the rating agency was concerned. Would you care to guess what the U.S. national debt was in 2011 compared to 2023? Get ready for it. Here come those stubborn facts. The debt of $16.7 trillion in 2011 increased to a whopping $31.2 trillion. That's with a T. For the same years, U.S. GDP rose from $15.6 trillion to $27.4 trillion. That's another T. Stay with me, please. Can you sense what is happening? Let me spell it out for you. The debt to GDP ratio in 2011 was 1.07. You arrive at that by dividing 16.7 trillion of debt by 15.6 trillion of GDP. In 2023, it was 1.13. That is 31.2 trillion of debt divided by 27.4 trillion of GDP. This is a straightforward mathematical issue. Those two ratios mean that while in 2011 total national debt was 6% greater than the total GDP of the nation, in 2023 the national debt was 13% greater than the U.S. GDP. And it isn't getting any prettier. These hard, stubborn facts lead to only one conclusion. We are economic and financially falling backwards. The U.S. has not yet had a failed auction. However, the U.S. economy is the big enchilada of the world economy. If its bond auctions fail, the whole world's economic and financial stability will be sorely tested. If you look back and around, you will find the warning signs of this impending crisis. In addition to the profligate expansion of worldwide debt, the most obvious sign of trouble since 2020 is the explosive growth of cryptocurrencies and their market size. In 2020, the market capitalization of those currencies was about 600 million. By 2024, it grew to about 2.5 billion. Why is this a problem? As you may know, normal currencies backed by national banks and their respective economies are the traditional store of value, along with gold and diamonds, priced in U.S. dollars, by the way. Faith in the U.S. dollar has fallen so low as a store of value that unsecured digital promissory notes, also known as your unique digital key to your account, are considered by many to be a serious store of value. Well, maybe they're just tax evading. Who knows? This is pure nonsense, because nothing at all backs the cryptocurrencies except the good faith and credit of who? No one. What is it like to live through a meltdown of the U.S. dollar? I know that I will be dating myself, but I did live through one in August of 1971. It was somewhat unsettling. I was traveling in Italy, in the Lake Como district, and having a grand old time. Everyone was eager to have my U.S. dollars to exchange into lira. They were keen until they were not. President Nixon suddenly stopped the convertibility of the dollar into gold. It was $35 in those days. What happened next? For several days, no bank or merchant knew the value of the U.S. dollar to the Italian lira, and other currencies for that matter. What did they do? They stopped accepting my dollars at all. I was left high and dry. Well, not really. My Italian hosts loaned me the lira necessary for the next few days. Everything was quite normal, and then the rug was pulled out for me. Many daily transactions involving Americans in Europe just stopped. That is what will happen when the next financial crisis hits. No one will know the value of anything. Many daily purchases and sales will never happen until the dust settles and the confusion subsides. The choice is up to us. Do we want to keep borrowing hell-bent for leather until we are knocked sideways? Do we want to take in hand our twin vices of overspending and gutting the future, or just do the right thing? The remedy is to rein in our spending. It's as simple as that. I realize that talking the talk of debt reduction is one thing, but walking the talk, either practically or politically, is more difficult. And certainly accepting the remedy of cost cutting is extremely difficult and unpleasant to many people, and certainly to politicians. We will be courting disaster if we fail to make the necessary cuts in government spending. What will economic and financial disaster look like? It will be something like a combination of people losing their jobs, their homes, their investments, and their pensions. Economic decline and hardship will be the order of the day. The global ripple effects will entail a severe contraction of U.S. power abroad, and very likely a war and increased civil disturbances at home. Foreign trade will just shrivel up. If you think I am making this up, just look back to the Great Depression of the 1930s to get a taste of what might happen. Perhaps you can speak to your grandparents if they are still alive, read a book or two, surf the net, or talk into your cell phone and ask your favorite ChatGPT guru for a brief history of the Great Depression. One more thing. How and when will this crisis hit us? It will seem to come out of nowhere, like many other crises, but will be obvious in retrospect. Here is my view of how events will unfold. The first shock wave will likely hit us after one or two failed bond auctions, followed by a severe decline in the US dollar and large interest rate jumps. When will this happen? I haven't the faintest idea, and neither does anyone else. Please don't get overly depressed. Nothing is inevitable. There is light at the end of the tunnel, and we will talk about that next week when we consider the productivity challenge. That is where you can do something without reference to any politician to stop and then reverse our economic decline. Our next episode will lay out how you can meet the multiple productivity challenges that confront us. You can access my ideas and thoughts by visiting Amazon.com and search for The Reckoning, July 4th, 2030.